In this video, we are going to explore what is the best time frame to trade in Forex, indices, and crypto. This is part of a series of videos teaching you how to trade using price action. The playlist is available at the Decisive Trading YouTube channel. Please take a second to hit the like button and subscribe if you find the content useful. When you come to the financial markets, there is a lot of choice when deciding on what time frame to trade. You can trade the daily, 4 hour, 1 hour, 30 minute, 5 minute, 1 minute, and many more. The time frame simply refers to the period of time that each individual candlestick you see on the charts covers. So if this is the daily time frame, each candle represents one full day of price movement. If it was the 4 hour time frame, each candle would represent 4 hours worth of price movement. If it was the 5 minute time frame, each candle would represent 5 minutes worth of price movement, etc. Most people settle on a time frame without giving it much thought. However, the time frame you trade is an important decision for a trader. What do you think is the most common time frame beginners gravitate towards? In my experience, it is very often the 1 minute time frame. That is exactly where I started. And from experience of working with lots of students, that is the most common route onto the charts. The common belief is that because it moves faster than other timeframes, it is more exciting. There is the opportunity for faster profits and gives the true trader experience. What you tend to find is that the 1 minute timeframe instead destroys trading accounts. The fast movements and excitement cause emotional trading, mistakes, and is very stressful. I do not suggest you start learning on the 1 minute time frame. That is the only time frame I advise against. If you are really interested in it, consider coming back after you are already consistently profitable. So for the remaining time frames, we need to consider 3 things: your lifestyle, your personality, and your situation. For the most part, people have other commitments outside of trading. That can be your job, school, kids, or whatever it may be. You must first consider what works for you and the balancing act that is your life. There is no point thinking you want to day trade, but your situation is that you work every weekday from 9 AM until 5 PM and have no time for the charts. Similarly, if you want to trade the 1 hour time frame, but can only look at the charts each evening, this may limit your opportunities and cause you to miss good setups. You have to consider what is possible for you and your lifestyle. If you want to be a day trader, can you spare at least a couple of hours at a time to watch the charts? Your lifestyle also ties in with your situation, which we will cover soon. Our next consideration is your personality. Being comfortable with the way you trade is a key component of trading success. As you start trading, you soon discover that the time frame you trade can have a huge impact on your trading psychology. If the time frame doesn't suit you, it can lead to mistakes and emotional trading that will cost you money. Some considerations for lower time frames are: trades can complete quickly. You don't need to hold positions overnight. Stops are usually smaller than on higher time frames, so it can be good for smaller accounts. However, faster trades can mean faster losses. You will have less time to make decisions. If each candle represents 5 minutes of price action, there isn't a lot of time to consider the entry before you might have missed it. Some considerations for higher time frames are: you have more time to make decisions. It requires less screen time than lower time frames. Trades can last for weeks and months. Some drawbacks are that a lot of people do not like holding positions long term and find it difficult to ignore the trade when it is running. This can lead to feeling stressed and also making poor decisions. There can be days and weeks between any potential setups. Stops are usually larger and require a larger account. Our final consideration is your situation. This mainly comes down to finances. It tends to be the case that the higher the time frame, the larger the stop size. As stop size increases, so does your minimum risk. If you have a 10-point stop and your broker has a minimum risk of £1 per point, you are risking £10 in a trade. If you are using a 100-point stop, which is common on the daily time frame, you are risking £100 on a single trade. Now that you have looked at the different factors to consider, I hope you have already concluded that the best time frame to trade is the one that suits you. That means your lifestyle, your personality, and your situation. Lots of people like to declare X is the only time frame you should be trading. But in reality, there are professional traders trading successfully on all timeframes. Whatever works for you is best for you. As always, I hope you found this video helpful. If you enjoyed it, please take a second to hit the like button. Subscribe to be kept up to date with future releases.